Tax-free cash individual savings accounts, ISA, have come under threat from Rachel Reeves as pensioners have been warned to expect a greater shock. Reports have revealed that the Chancellor has been pressured to cut tax relief on cash ISAs to push savers towards more volatile investments. Reeves met with City firms who claimed that the £300 billion held in cash ISAs would yield better results if they were invested in riskier stocks and shares ISAs. Rachel Reeves has been urged by the City to cut tax reliefs afforded to savers by means of the cash ISA. Apparently, she did not rebuff the idea. Excellent news. She should go all the way and abolish it entirely. Approximately £300 billion sits unproductively in this absurdly generous savings pot, offering shelter from the taxman to the tune of £20,000 every single year per adult, for no benefit to the government. This is unacceptable. Every tax break comes at a cost to the government and each one should result in a net gain for the nation. The history of the ISA regime is a short one, and Ms. Reeves should not be afraid to rewrite it. Beginning with Nigel Lawson's PEPs in the mid-1980s, individuals were offered exemption from capital gains tax and income on a limited basis if they invested their cash into London's stock markets, broadly speaking. This evolved into the stocks and shares ISA, in which I still firmly believe. The government offers a tax break and in return individuals take on some risk and pump capital into our businesses and stock markets, fueling growth and giving people a larger stake in society. A fair trade and a smart idea. Some believe that even this remains too generous and should be further restricted to UK assets, as argued by John Lee, Britain's first ISA millionaire. The lifetime ISA also benefits us all. For the very generous tax break it offers, the government effectively guarantees fueling the property market, as the use of this tax-free cash is restricted to buying a house for the first time. It certainly has its issues, particularly the maximum house price, which limits London buyers, but it is a fair trade and a smart idea. The cash ISA, however, is a one-sided trade. For taking money out of the economy and parking it away from any productive use, individuals are rewarded with extremely generous tax breaks. Neither fair nor smart. Even its predecessor, John Major's TESA, was better able to justify its existence with time-limited exemptions and more punitive withdrawal rules. We understand that a large reason for the raising or lowering of interest rates is to stop or encourage people to spend money in the real economy, and the Bank of England seems set to further lower rates to encourage this behaviour. We also know this government is particularly concerned with growing the economy. It seems absurd to spend money actively encouraging people to keep their cash out of the system. Of course, there is no fair or cost-effective way to retroactively apply the rules, so I'm not advocating to stick people with massive tax bills for utilising the system afforded to them. Instead, all future ISAs should be restricted to stocks and shares. Those who still wish to access tax-free cash savings should be directed to NS&I, which directly finances the government. A fair trade and a smart idea. The cash ISA was always too generous, but it has since become an unaffordable relic of a bygone economic era. Ms. Reeves must be bold in her pursuit of growth. It must go. If you found this information helpful, be sure to check out my other videos on personal finance and leave your thoughts in the comments below.